New data out this week giving a fresh look at the health of the economy. The Fed's favorite inflation gauge slightly higher than expected at 2.7% annually. Month over month, inflation remained flat at 0.3%. The economy also growing much slower than expected in the first quarter at 1.6%. That's below the 2.4% estimate and drastically down from the fourth quarter's nearly 3.5%. Joining me now is Invesco global market strategist Brian Levitt. Brian, great to have you back.
Great to be here. Thank you.
So higher inflation, lower growth, not an auspicious combo. Should we use the stagflation word?
I wouldn't call it stagflation.
Okay.
So it's certainly not stag. This is an economy that is still doing well. If you look beneath the surface of that GDP number, a lot of it was imports took away from growth, and you had some slowdown in business investment. The consumer did fine. Now, inflation, we could debate, right? And yeah, the numbers are still a little bit hotter. It's not broad. There's some components driving it, and it's a little bit higher. But I would still come back to the fact that good nominal growth, which of course includes inflation, is not necessarily the worst place to be for investors.
Can you just explain that dynamic briefly? So if the country imports more, that actually subtracts from the GDP print?
Well, we have we all probably remember the first day of our economics classes when they told us GDP equals C plus I plus G plus NX. So net exports, yeah, of course, exports minus imports. So
Got it.
Yeah,
Okay.
yeah, the consumer's been importing, so it's a bit of a drag on it. But again, the consumer's held in nicely.
It's always dangerous to cherry pick this data point and that data point, but I do want to cherry pick nonetheless. In the inflation print, a very large part of that is something called owner equivalent rent.
Right.
Can you explain that and how that can possibly distort inflation numbers?
Yeah, so owner's equivalent rent is basically what would it cost you to rent your home.
But that's a guess.
That's a guess. Nobody's actually paying it, right? We all have mortgages and whatever expenses and fees we have. So it's a guess, and it tends to lag what's actually happening in the real world. I like to look at Zillow will put out a number, S&P Core Logic will put out a number, and this is what it costs to rent home prices. Year over year, those peaked over a year ago. The owner's equivalent rent is peaked, but remain pretty elevated. So it's slow to come down. It usually lags. A lot of people, and myself included, suspect that's what's keeping some of the CPI services sticky.
Now, investors, and we in the media are guilty of this as anybody, are always looking to, will the Fed cut, in May?
Yeah.
Will it be July? Will it be September? And really, for the longer-term investor, it's not that important. What are you watching? What are you telling investors to be aware of?
It's not. This is like the new pastime, right? We used to go to baseball games. Now we go to parlors and debate what the Fed's going to do.
You can bet on it.
Yeah, the beginning of the year, the market thought 6 rate cuts. Now you're down to maybe 1 or 2 embedded in the market's expectations. I don't really care too much. I'm thrilled that the tightening cycle's over. We didn't enjoy that in 2022. I'm thrilled it's over. The Fed will ultimately ease. It's just a matter of when we get there. So for the intermediate term investors, my view has been, and it's worked nicely so far, peak inflation, which happened in June 2022, peak tightening, which happened in July 23, peak rates, all tends to be good for the stock market over the subsequent years. Doesn't mean every day, but over the subsequent years. And so far, that's been playing out quite nicely.
One more investing question for you. So we've long said on this show that one should separate political beliefs from your investments. Right? Political is very emotional. That's not the way to treat investments. But you actually put a chart and numbers on this, and I was actually blown away. I mean, I agreed with you. I didn't know how much I agreed with you.
Yeah, the magnitude of it's pretty significant.
Can you break that down for us?
So the magnitude of it is significant. What I did was I found an index that goes back as far as I can. That's the Dow Jones Industrial Average Price, not total return. Back to 1896, I believe Grover Cleveland was president. I say you put $10,000 and you hold it for the whole time, it climbs to over 10 million. Then I said, what if I came out of the market and went to cash every time a Democrat was in office or every time a Republican was in office, and your results are your 10,000 climbs to a few 100,000.
Wow.
Right, so much further below the 10 million. And you think about it, if you didn't invest when the Democrat was in office, you missed the 90s under Clinton, you missed the 2010s under Obama. If you didn't invest when a Republican was in office, you missed the 80s during, you miss those times, it significantly impacts your portfolio.
Vote your conscience, stay in the market the whole time.
Exactly.
Brian Levitt, thanks so much for coming by. Good luck to the Rangers.
Good luck to the Rangers. Thank you.